Hi there. This is Ken Medlock. I'm the director of the Center for Energy Studies at Rice University's Baker Institute for Public Policy, and welcome on this Friday afternoon to a discussion about natural gas. We've been holding for about a month now weekly webinars every Friday to discuss issues that are incredibly relevant, not only to just energy markets in general, but also deeply ingrained in the research that we do here at the Baker Institute. I have with me Anna Mikulska and Stephen Miles. They're both fellows at the Institute. I'll let them give broader introductions of themselves in just a moment when I hand it over to them. We're going to be talking about natural gas, not just from the North American perspective, but also from a global perspective, because COVID-19 and the issues that we're living through currently extend well beyond our borders. This is first and foremost a major economic and hence demand shock that's affected energy value chains regardless of fuel source or energy type. And natural gas is no different, but remarkably, we are seeing a sector that is a little bit more resilient than what we've seen, for example, in oil or even in coal in some places. So getting into those dynamics and the different parts of the value chain of gas is what we're going to strive to do today. One of the things I think that's important to kind of create a level set for the discussion is to note the role of the U.S. in the global gas market as it's been evolving over the last decade. Or so. Has moved from a position where we were largely going to be a net importer, it was thought. The shale revolution happened and it turned the natural gas world upside down. The US is now a significant LNG exporter with most projections, especially prior to the COVID demand issues, really set U.S. grows significantly. And quite frankly, there are still, there still is significant sentiment that it will grow going forward. So with that, and I should note as well, all of this has been happening on the supply side for the U.S., despite the fact that prices have generally been trending down since roughly 2008. As a matter of fact, the price environment in North America has grown less volatile and generally lower over the last decade than it did the prior decade. And that actually speaks to the resilience of the gas sector in North America and in the U.S. more generally, which I will come back to later. So with that, I'm going to pass it over to Stephen Miles, and then he will hand it off to Anna, and then we'll come back and get involved in a conversation and address some of the questions that you have. So Stephen.
Thank you, Ken. Just in brief, it's been my real privilege to have an opportunity to join as a fellow at the Baker Institute, Center for Energy Studies at the beginning of this year. And over the last 19 years, I've had the real joy of being a partner at Baker Botts and heading up the LNG practice there. And hopefully some of my colleagues have had an opportunity to join us. I'm going to speak for just a few minutes about the impact of lower natural gas and LNG prices on LNG producers and developers, and the particular focus on North America, but we'll go a little broader than that. I'm then going to, at the end, propose one possible course of action that could alleviate some of the strain on the U.S. market. From a North American perspective, it's important to recognize that North America is an interesting and unusual case compared to the rest of the world, because most of the projects in North America are either tolling or they are SPA models, that is sale and purchase agreement models, far less so integrated, which we find elsewhere in the world. And the result of those model differences is that the customer has the opportunity to cancel its upstream commodity portion of its purchase, and if it does so in a timely way, not to pay that commodity piece. And so as a result, the fixed cost component ends up being a bit of a two-edged sword for North American producers. On the one hand, North American producers are relatively immune to small numbers of cancellations. They're going to continue to get that fixed cost component. They're not going to feel the immediate pain, but which they've pushed either to the upstream producer or to the downstream customer. On the other hand, wide-scale, system-wide cancellations could raise the prospect of shut-ins for US projects. I think that's unlikely, but it can occur, and it can occur for any one of a number of reasons. It could occur because in one case, there are perhaps so many cancellations that the facility isn't able to get gas to keep cold, and it doesn't want to take the commodity risk of purchasing that gas. In another instance, it might have exhausted its downward flexibility in gas supply contracts to the LNG facilities. And in another instance, the off-takers may also be shareholders who have elected to shut the plant in order to reduce their total financial burden. So these two models, the tolling and the SPA with cancellation rights, really make the US and North America different than the rest of the world. For those North American projects that are still under development, this is going to be a tale of two very different outcomes. And for those projects that have already obtained their customers, they have obtained and secured financing for their projects, they're very likely to continue on with construction, to see their way through to commercial production. Why is that? Well, they have their financing in place. The developers will want to go forward. The LNG buyers, even if they see that their specific purchases may be underwater at current market prices, they would likely want to take the bet that they'll see how things are in the 3 to 4 to 5 years before the project comes online, rather than default now and pay damages now. But for those projects that have not yet been able to secure financing or not yet been able to obtain a steady panel of creditworthy customers to long-term contracts, it's not likely to get any easier over the next year or two. The US was among the lowest cost supply sources until recently. It's now among the highest on a delivered basis. As of yesterday, Henry Hub prices were only 10 cents below delivered TTF prices and 11 cents below JKM into Asia, both for June contracts. There have been reports of some 57 summer cargoes that have been canceled from 4 US export terminals. At least 8 of the proposed North American projects have announced significant postponements in their schedules for completion, for FID and completion. And the reported inability of one prospective buyer of LNG Limited, the owner of the Magnolia LNG project, to secure financing for some $35 million or so purchase price. These all raise questions about whether and what role these projects that are still have yet to get their customer panels in place and their funding in place, at what point in time they may proceed to FID in the future. The extent to which they're able to continue on in the interim will depend to a significant degree on to what extent private equity and other capital raising mechanisms are willing to carry them for this period of time. Certainly, a number of these projects have already received through the years some significant amounts of private equity and other capital, and so there may be some very understandable desire to invest more to be able to see these projects through this trough. We'll just have to see how that goes. But what happens if we do indeed have wide-scale cancellations of cargo liftings from US projects? What happens if among the existing projects, those that have gone forward, those that are producing, these 57 cargoes become a much larger groundswell of cancellations? Truly, this must be another unprecedented situation. Well, not really. In the 1980s, the US had 4 LNG import facilities. Crashing natural gas prices caused the buyers to cancel their cargo purchases, and ultimately 3 of the 4 projects were mothballed. All are now export facilities. The financial impact of a shut-in or mothballing is very real on investors and lenders. There's no question about that. But a multi-billion-dollar LNG facility is an asset that's not going away. It's like gas in the ground. It's going to stay there until prices rise enough to justify its exploitation. So, and even while shut in, the LNG plant may continue to have an impact on world markets and prices because, as Ken would likely tell us all, the threat of competition is itself competition. Is there anything that we all can do to improve this situation? Well, no one actor or even one set of actors can move energy markets. They're obviously just too large. But there is one lever that we might have that may be useful to deploy. The US-China Phase 1 trade agreement signed January 15 of this year requires China under Article 6 to purchase $50 billion of US energy products. That is LNG, gas, but it's also some other products as well, LPGs and refined products. They have 20 months left under the agreement to fulfill that obligation, and only the most incremental progress has been made thus far towards fulfilling that. And so one possibility is that rather than pushing China to purchase a bunch of spot cargoes in the next 20 months, which will not have much impact on US employment, certainly, because there's no new construction, no new building or development, no new pipelines with respect to buying spot purchases. But it's not even clear that the benefits would accrete to US parties and interests. The spot cargoes may well be bought by third parties that already have contracts to take their cargoes, lift their cargoes from US terminals, and then they sell them on the water, or they divert them to China. So pure swaps or resales of spot cargoes are unlikely to really move the needle on some of the major metrics for the US in terms of job creation and investment. But if the US and China were to agree that the proper interpretation of Article 6 was that China's commitment to long-term purchases from new or expanded US terminals qualified, well, then you'd see the opportunity to have a new project or two developed with the thousands of workers that typically requires in the first several years during the construction phase. You would see most likely capital raised and deployed in the billions of dollars to support that. And you might actually move the needle in terms of being able to get some workers, particularly in the US Gulf Coast, who are currently suffering, to have opportunities there in terms of developing, constructing, and operating a new major project. So that's something that Ken and I have both talked about in the public domain, and so I'll leave it there, but I look forward to any questions people may have. And Anna, I think it's your turn.
Thank you, Stephen. Hello, I'm Anna Mikulska. I'm a non-resident fellow for the Center of Energy Studies at the Baker Institute. And my background is actually in law and political science, international relations. So a lot what I look at is from that perspective. And what I look at a lot is also natural gas and its geopolitical implications in Europe, and specifically in Central and Eastern Europe. Again, as you probably will figure it out, listening to my accent, that's the region I'm from. So I'm just trying to use my comparative advantage here. So kind of going to what Stephen has been saying with the development of US LNG and so on, and what Ken has posited with the transformation of natural gas markets globally. Specifically, where I look at in Europe, this transformation has been huge. And while in the Western Europe, we already have seen quite interconnected markets with greater number of supply, the Central and Eastern Europe has been undergoing a huge transformation that's based to an extent on the US LNG that's flowing into that market now, and also other types of supply. So kind of going back around a decade, this has not been the case. Europe, Western Europe again, still had diverse set of supply, very interconnected, by Central and Eastern Europe has been very much dependent on Russia for its supply of natural gas. The pipelines that have been banned were built under the communism were going only in one direction, and it was by design that there wasn't much of an interconnection between those countries. So in many countries, in many countries, Russia was not only dominant, it was also the monopolist. And because of this, it was able to extract two types of benefits. First, economic benefit. It could actually, and it was able to charge higher prices. So for example, Poland would pay higher prices on the gas delivered from Russia than Germany or Italy, even though the transit fees that would be included in those prices would be lower. And that was because of the monopolist or dominant position that Russia was able to had at this moment. But with the shale revolution and advances in liquefaction technology, and with the boom in LNG markets, the natural gas market has become much more interconnected, much more liquid, and the region has understood that this is a way in which it can transform itself and become more like the western part of Europe, where countries where Russia wasn't as dominant and couldn't get both economic and also geopolitical benefits, in which it could actually, and it has, over the period where the Central and Eastern Europe was dependent, was influencing Russia was influencing the region politically. So we've seen actually infrastructure buildup, and that has been the LNG terminal in Lithuania, independence, and very shortly thereafter, the LNG terminal in Poland. And actually what we have seen, particularly in Lithuania, as the contract with Russia was at that time already about to expire, the prices in Lithuania have dropped dramatically by approximately 25%. In Poland, the contract is expiring in 2022, and already Poland has contracted US LNG at a price that's 25% cheaper than the gas that Poland is now receiving from Russia. So we see that there is this, now there is an ability for those nations to arbitrage and buy gas at cheaper prices, and Russia has to lower their prices. And on top of it, cannot expand its geopolitical benefits. And US has been very interested in helping the Central and Eastern Europe getting out of this Russian dominance. And we have seen diplomatic influence many times. The Trump-Juncker agreement in 2018, when President Trump has promised US LNG to coming into the US, and Juncker has at that time promised that EU will accept it, has been very much this kind of more of a symbolic gesture, but a very important one in which both of the sides are committing themselves to be to work together. One thing that we have to remember is, though, that US government, unlike many other governments, or for example, unlike Russia, cannot promise to deliver LNG or any type of gas. It doesn't own it. It can promise to help doing so. And same goes for the EU. EU cannot promise to bring in specific amount of gas. It's specific nations in the EU that will or will not, and the companies within them that will bring that gas. So that's very important to understand and remember. That being said, that gas that's coming from the US, it's very important because it makes, well, one important thing about this gas is this flexibility of the flexibility of the contracts that has already impacted the region. And that means that Gazprom contracts have become more flexible, and other contracts have become more flexible as well. And when we move this, and the US government also has recently committed itself to bring in budget to help the infrastructure to develop this market even further. So that could be actually help. But one needs to understand one thing, that this help that US government could potentially provide is not bringing in specific US cargoes, is bringing in more liquidity to the market and ability to trade. And by that, US will actually gain a geopolitical advantage, not a direct one in influencing specific countries, but an advantage in minimizing both geopolitical economic advantage that Russia has in the region. And that has been visible already. So kind of going back, what's happening now in the European natural gas market. The first quarter of this year has seen basically record levels of imports, LNG imports, and record levels of US LNG imports into Europe. It has been related not necessarily with the fact that there is a huge amount of demand, but it's because one, US actually has quite a lot of storage that's very convenient at a time where prices are low, but also two, because a lot of the contracts pipeline contracts have become very flexible, and a lot of buyers opted to buy LNG instead of additional pipeline contracts. So in that, we already seen that this US LNG that is flowing now into the region creates this opportunity of arbitrage. Now, what's important to understand, and then again, this goes to what Stephen is saying, that's not necessarily the physical flows, but the ability to deliver gas, a specific amount of gas to a region that provide this credible threat to any single supplier that could be otherwise dominant in the region. And with that, I refer to Ken.
Thank you, Anna. Thank you, Stephen. I think that's a great sort of way to begin a discussion about the broader implications of what's been going on here in the U.S. But I think just to bring it back home, I'll spend a couple of minutes just talking about what's going on here. I think first and foremost, it's important to understand what's been going on with price in the North American gas market really over the last 20 years. If you just go back the last decade, roughly 11 years or so, the average price of natural gas has been around $3 an MMBTU, a little bit north of that. But the decade prior saw prices averaging above $5 an MMBTU. So there's been a significant downward shift in the average price. And it's not just about the average price, it's also about the degree to which prices fluctuated around that average. Volatility is about, it's significantly lower today than it was back just a little over a decade ago. All of this really signals a couple of major things. First of all, the supply situation in North America has become incredibly robust. It's important to note that all of this has been going on in the price dimension, despite the fact that demand domestically has also grown. Power generation today is roughly 40% of domestic gas consumption. It has been by far the largest source of increased demand domestically. And all of that has been occurring in the wake of declining prices, which you might expect a positive sort of demand result of that. But also gas displacing coal significantly, an aging coal fleet in the United States. So, natural gas has really been a boon, not only on the environmental front, but also the economic front for the United States in terms of being able to provide a lower source of fuel, lower cost source of fuel into power generation and industry, which is the second largest consumer of natural gas domestically. So it's interesting to note that post 2009, we all sort of typically think about, when we think about commodity prices, what happened to the oil price complex, right? Oil peaked at about $147 a barrel and then crashed in the latter half of 2008 down into the $30 range. But then on the back of economic recovery, quantitative easing, et cetera, prices jumped back up to around $100 a barrel and stayed there for a few years. That actually set the stage for significant entry into the upstream space in terms of oil-directed activity. And quite frankly, when oil prices crashed from 2014 through 2016, chased some of the capital out. And then we saw a massive recovery to the tune of 4.5 million barrels a day of overall liquids production from January 2016 through January this year. All of that has been very sensitive to movement in oil price. On the gas front, though, which I think is really important for understanding this because it really paints a different picture about the resilience of the sector. Gas prices didn't jump back up post 2009. They actually stayed relatively low. There was a brief period where we got a little over $4 an MMBTU, but generally we've been below that level. And despite that, you've seen significant increases in domestic gas production, both just dry gas production, but also associated gas production. The associated gas production should be expected because it's linked directly to what's happening in the oil space. But gas producers, the dry gas producers in North America did not benefit from a dramatically rising oil price post 2009, yet they were still able to increase the amount of production through gains in well productivity. In fact, active rig counts that were natural gas directed have been declining, but gas production has not, which really speaks to that point. So as we look forward, even though we're in roughly a $1.80 to $1.90 type of environment at Henry Hub right now, the collapse in oil prices actually benefited some domestic gas producers. In particular, we've seen just over the last week, prices in West Texas at the Hub Waha have been trading in positive territory. That is a region that has been pretty well known for seeing negative pricing of natural gas over the past couple of years for extended periods because of lack of takeaway capacity and the massive growth of associated gas production trying to get into the system there. So we are seeing sort of a mixed set of results, if you will, for domestic gas producers, which really is it really does speak to the resilience of the sector. In fact, natural gas producers are actually well equipped to deal with what we're seeing right now. On the storage front, that's another thing that is actually very beneficial for U.S. producers. Storage in North America is generally commercial. It is incentivized as a result of that and a result of market-based pricing for storage services. It's incentivized a lot of investment in storage capacity over the years. And as a result, we're not running out of storage for natural gas the way we hear about running out of storage for oil. In fact, right now we are according to the latest EIA's weekly storage report, we're about where we were this time of the year in 2017. So that really speaks to there's still room for product to move into storage, but quite frankly, it hasn't really been needed yet. And that speaks to the resilience on the demand side, in particular gas into the power sector, gas into petrochemicals as a feedstock, et cetera. So there's a lot of interesting things that are going on that really do support a much more positive story on the gas front than what we typically hear on the oil front. Now, all of that said, it's important to recognize that the U.S. has turned into a net exporter of natural gas. And so the future of natural gas in North America and the U.S. more generally is very tied to what happens abroad. And the economic pain that is being felt in Asia, in Europe, it really does have direct implications for gas, which has been trying to grow in both markets, not just Europe, but also in Asia substantially. And to the extent that those economies are in pain, are not experiencing the types of growth that was anticipated, you'll continue to see weakness in pricing at regional international gas market hubs like TTF and JKM, which Stephen mentioned before. But make no mistake, in those regions, there's not a large amount of storage. There's not a large amount of domestic production. So as soon as demand begins to recover in those regions, it runs into domestic capacity constraints that will drive price up again. And that will actually bode well for LNG exporters all over the world, including those in the US. The barometer, the thing to watch, if you will, is how long that takes. And that really does speak to the economies of the world really need to get moving again to really support long-term growth in US LNG exports, much less the gas market in the United States itself. So, as we look forward, there's a lot of question marks still, just like with every other energy commodity. But in general, it does, at least on its face, look like gas is doing a little bit better than many other commodities. So what I want to do now is turn to a few questions that have come through. Let me see. First one I want to ask, it really does speak to something that, Anna, I think you touched on regarding the European Commission and actions related to Russian efforts into, to hinder sales into Ukraine. When we go, Russia and Ukraine have been disputing about gas prices going back to the collapse of the Soviet Union, and then back in the middle part of last decade, the early 2000s, we saw that actual pressure reduction, right, which was a disruption in supply, and it's really stoked a lot of reaction on many fronts. And so I wonder if you could maybe expand a little bit on what the European Commission is currently doing with regard to Russian sales into Ukraine and how it affects the European Union more generally.
So thank you for the question. For now, basically, Russia has, as Ken has said, Russia and Ukraine have a very difficult relationship. And where Russia has been quite, supporting the flows in gas flows through Ukraine and to Ukraine since the fall of the Soviet Union. But it wasn't just to support Ukraine; it was with with strings attached, and that included political influence. And when that influence started to wane, including Ukraine becoming closer to the European Union or trying to become part of the NATO, Russia has become increasingly not happy with the setup and has started to first increase the price. So Ukraine has been using natural gas from Russia that was priced at half the price that the gas that was going somewhere else, or of the market value, and also was able not to pay it. I mean, that it could accumulate debt. So Russia would start asking for paying the debts that were there, or it would increase prices to the market level. After Russia invaded Ukraine, those relations become even more difficult. And actually, since 2016, Ukraine hasn't. In 2016, Ukraine stopped importing Russian gas. Now it still transits Russian gas, but now actually it re-imports that gas that transits through its territory back from Poland, Hungary, and Slovakia. So the EU has been working with both Russia and Ukraine, trying to convince Russia to keep at least part of its transit via Ukraine, which Russia wants to switch to a new pipeline that it has been building, which is Nord Stream 2. And you might have heard about it, since it has been stopped almost at the end of its construction by the US sanctions end of this year. Now, so based on these sanctions, Russia wasn't able to complete Nord Stream 2, wasn't able to move that potentially all of its transits to Nord Stream 2 that goes under the Baltic Sea directly to Germany. And EU has been pushing also for a continuing transit through Ukraine. Literally a day before the transit contract was about to expire between Russia and Ukraine, a new contract was signed, and now it will actually the new contract is through 2024 with approximately half of the capacity that Ukraine used to lend to Gazprom to send gas. EU has been another way which EU has been pushing for Russia to behave like a regular supplier of natural gas is to unbundle, which basically means that the same company that owns gas cannot also own the transmission networks, and that's obviously what Gazprom is. Gazprom owns the transmission networks and gas, and that is becoming an issue also now, as Germany, I have just read about it, Germany has basically been signaling that it might not give Gazprom an exception from that rule. So even if in that case, even if the sanctions won't stop Nord Stream 2, that will become a very difficult thing for Gazprom to do, especially since even the new law, new natural gas law that Russia is trying to implement this year, we'll see whether or not it will implement, it specifically leaves the transmission networks within Gazprom as part of creating a stronger entity. So it's almost against it's interesting because it's almost against the market trends and the EU developments in the EU. So that's kind of in a nutshell.
Great, thanks, Anna. So Stephen, I'm going to pose the next question to you, and I might chime in here too, because there's been a couple to this effect, but what do you think the impact of the collapse in the commodity price complex, so oil prices in particular, will mean for the future of contracting? In particular, oil indexation versus moving to a sort of a spot basis on gas, and how do you think that might actually, play out in future sales agreements?
Sure. Well, the challenge on moving to a spot basis for gas or the other commodity is, can you do that and still be able to create the capital necessary to fund the multi-billion-dollar investments? And it may, at the moment, look like the spot market's going to be here forever. There'll be tons of extra cargoes in the secondary market. Certainly that's true for a while. But in the long term, as economies get back on track, reopen, hopefully start to develop again, I think we're going to see the demand shock, which is what you talked about, Ken. The demand shock start to lessen and abate, and then eventually become a supply story. So I don't think, I think the rumors of the demise of the long-term contract are probably exaggerated. I think we will continue to see those projects. Now, will there be more flexible pricing? Will there be more flexible quantities terms? This is something that the market and buyers in particular have been pushing for a number of years now with some success. And I anticipate that trend will continue. Sellers have to be aware of the challenges. We've seen Asian buyers in the last couple of months exercise their DQT rights, downward quantity tolerance rights, to on their own, so just to reduce the quantities that they have to take without paying for that extra amount. Force majeure clauses are going to be pretty critical. We've seen a number of force majeure claims already this year due to the pandemic. At least that's the grounds upon which they've been put forward. And whether those stick or not, and by the way, not just from China, whether those stick or not really depends a lot on the contracts and how those force majeure clauses are worded. They're several pages long for a reason. People have thought about many potential ways that these issues could end up being deployed and addressed. And so those terms are going to continue to be very important. So I think the future of long-term contracts is good. The future of building the projects that are going to require those contracts, that's going to take getting over this demand shock.
Great. Thanks. So there's one interesting question that I'll nothing really to add to what Stephen said. I think the idea there is, first, before I go to that, the idea there is pretty sound. Namely, long-term contracts are critical because they're bankable, right? They actually can underpin financing. It's really about the evolution of the terms in those contracts, moving to more flexible terms that allow redirection, just generally more flexibility that can lead to more liquidity in the marketplace. And I know that a lot of the larger Asian customers, like Japan, for example, have been pushing for increased liquidity, and there is an ongoing discussion in Asia in general about where the next hub will ultimately emerge. And I think that debate has yet to be settled. I have lots of thoughts on that, but given time limitations, I'll move on to some other questions. One of the questions that came through, I think is kind of interesting, is related to Russian LNG being delivered into New England. And I want to make a comment about that because I was actually testifying at the Senate Energy and Natural Resources Committee hearing on LNG markets a couple of years ago when this actually happened. It was sort of at the height of concerns related to Russian interference in the U.S. elections, and things were boiling over, if you will. And the question was asked, how did that happen? It happened simply because that's what the market dictated. Just to put it bluntly, yes, we were exporting LNG, from Sabine Pass already at that point. But one of the issues with moving LNG from a U.S. port to another U.S. port is there are no U.S. flagged LNG carriers. So you have to actually get a Jones Act waiver to do that. So when you see demand spiking in a place like New England where there are pipeline capacity constraints, the next option that they have to utilize is LNG imports. And if the cheapest source of LNG is a cargo that's reloaded in the UK that has Russian gas on it, then that's the one that will land. And that's exactly what happened. So that was the global market basically reacting to a set of constraints that affected what supplies were available to New England for import. So that does happen from time to time, and it will continue to happen from time to time unless there's an outright embargo on any Russian LNG into the U.S. So I thought that was an interesting question. It came up during the hearing, but it really does speak to the resilience of markets ultimately as they react to constraints that are placed on them. Let's see. Lots of questions here on, here's one actually that I think both of you might be able to speak to a little bit. Beyond the US, thinking about LNG export project delays, particularly for those that haven't actually received FID and moved into construction. There are some other projects around the world that are actually seeing some delays announced for a variety of reasons. And I wonder, Mozambique in particular is one that has been discussed. I wonder if you could each, and maybe I'll start with you, Stephen, speak to that and what that might mean for the future gas market balance globally.
Sure. Again, as we had with the U.S., where I think I mentioned 8 projects have announced some significant delays. We have a number of projects, and not just Mozambique, of course, which has multiple issues going on there, but also certainly in Australia and in Qatar. We've seen some delays. We've also seen some reductions in project size and scope. Again, I think this is a demand shock issue. I think once we get back to filling in the trough and economies get back to being more or less where they were before, I think these projects will get back on track. A number of them have very positive economics. One of the more interesting things that people have mulled about recently is when we see cargoes imported to the U.S. There's a discussions being had that it's actually a few pennies cheaper to import into the U.S. now than into Europe. Ken, you were chatting about this earlier, and Anna. That's probably a very short-term phenomenon. But what might make more sense there is actually using the U.S. as storage. Some of the terminals that are not at full capacity and where buyers are canceling cargoes in particular. We've seen one cargo into Cove Point that looks like it's for storage purposes. So we could see that happening a little bit as sort of an interesting counter trend to the last 7 or 8 years.
Great.
Right.
Anna, I'm going to get you to build on that, but talk a little bit in your response, a little bit closer to home to Europe, about developments in the Eastern Mediterranean and how they're going to be potentially impacting Russia's position vis-a-vis Europe, and how Europeans, consumers generally view those Eastern Mediterranean resources.
Right. So we actually will see, we have seen over last year increased activity in that region, including that now the terminal in Kirk is the terminal for import terminal LNG at Kirk, and the Croatian island has moved on. It took a while, but now it seems that it will be also financed by the EU as a project of common interest to increase the competition. Since this region particularly hasn't moved on the diversification part of the natural gas. We have also seen Turkish Stream now landing in Turkey and able to deliver also to Europe, and that's from Russia. Pipeline from Russia, but also Azeri Gas has also got in, is now being transported via pipeline to Turkey as well. Turkey seems to be growing as this hub for delivery of different types of gas, including LNG. A lot of LNG, I think most of US LNG went to Turkey compared to actually every other destination in Europe. So that's Turkey has been moving very strongly to become this gas hub for Europe. For Russia, it's actually quite convenient because it doesn't need to meet the unbundling principle. So Gazprom can just deliver to Turkey, and Turkey can move the gas further out. However, there have been several European projects that haven't been finished yet and do not allow those pipelines to transfer maximum amounts of gas. So in that way, actually the Russian Turkish Stream hasn't been able to deliver much into Europe. And also Azeri Gas hasn't been transferred really into Europe because the connecting pipeline that was supposed to be finished in Europe hasn't been finished yet. It's been promised for October now, but it's a delay. So we have seen there that there has been some delays, but also some promising developments with projects of common interest, and increasing diversification of gas, not only in Central and Eastern Europe, but also Southeast Europe, which is quite important because countries like Bulgaria have been relying on Russia, for example, 100% on the gas. Now, interesting part is that Bulgaria's gas contract just expired recently with Russia, and the new contract prices are 40% cheaper. Yeah. So that's good.
That's actually very interesting because in general, what we're seeing, I think, with regard to Russian gas into Europe is increasing competition with multiple sources of supply, which does, I think, address exactly what you mentioned with regard to geopolitical influence in the region. But I wonder if you could maybe say a couple of words, because I know we've talked about this, with regard to aspirations in Russia to expand its footprint in the LNG space and sort of what's driving that.
Right, and that goes again to the issue of, well, which LNG projects we're gonna see. And one interesting thing about this in Russia is, in Russia, the company that leads LNG production is Novatek. It's a private company, not like Gazprom, which belongs to the state. It's a private company. It has been supported, however, by the Russian government, and we've seen it again and again. For example, it enjoys the tax holiday. And that same tax holiday was actually not given to Gazprom, even though Gazprom asked for it. So that's quite interesting. And Russia has very recently released its strategy, and it has basically, and that strategy suggests that Russia will put a lot of pressure on developing LNG. In fact, any type of most of the increase in gas production is supposed to come from LNG projects, which means the current Arctic LNG, Yamal LNG, but also Arctic 2 LNG that now is being developed. And as to the delays, at least for now, Novatek has been basically saying that they will be on track. There's gonna be no delay. And one interesting thing about Novatek is that they have basically said, we don't need any contracts ahead of time. So it goes again to what Ken was saying, it's important, or what Stephen was saying, is important to have these long-term contracts to underpin financing. Well, for Novatek, despite the fact that it's a private company, it actually doesn't matter. And I've heard it also from when I was on a panel with their CFO, we don't need those contracts. We know that LNG is gonna be in demand. And on this basis, we are developing this project. Obviously, they can do it only because the Russian government supports them quite a lot, including building nuclear LNG cargo ships that could transport LNG directly from Arctic to China, even over the winter months. And also building the port in Sabata that could be part of this kind of bigger Arctic development and promote Russian LNG around the world.
Great, thanks. So an interesting question that really I think speaks to the future of gas, and there's been a lot of pontification about this in a variety of different outlets from a variety of different analysts. But the question specifically is addressing EU's commitment to an EU Green Deal and what that could mean for the future of natural gas and whether or not it might actually present barriers that are non-market barriers to LNG sourced from the US because of methane emissions or flaring. But in general, in addition to addressing that specifically with regard to Europe, I wonder if you could each share comments or thoughts on the role of natural gas going forward in the overall energy demand complex. So Anna, I'll start with you and then go to Stephen.
Sure. So yes, EU has very big plans in terms of the European Green Deal and so on. And there are recently two different ways that has been approached. And some people believe that this is actually going to be pushed forward now because we can get rid of all the fossil fuels and just push for renewable development. This is the time to do it. But there's more skeptical side also to it, to the discussion. We say, well, maybe now it's not going to necessarily be the time. Cheaper fossil fuels may actually help countries to develop and grow and kind of get out of the recession. There's also this issue of switching from coal to gas that I think can be achieved, and I think that's where natural gas will have that edge over coal going forward, and that's when we could see the improvement and kind of natural gas coming into being much more used much more in the EU. Past the recession or past the downturn that COVID has imposed, and that particularly could be in Central and Eastern Europe actually, because that's where a lot of coal is being used. So we see this in Poland, but also Germany. Germany uses quite a lot of coal. Yes, they have promised that till 2038 they will get rid of it, but still at this point they use a lot of coal, including brown coal for power generation. So at this moment, if natural gas is cheaper, we might see actually faster change from coal to natural gas. We've seen this in Spain. I think in 2019 already, cheap gas has provided actually this impetus for changes and that's why we ended up actually having much more LNG imports in Spain also.
Great. Stephen?
I agree with Anna exactly. If we look at the role that natural gas, renewables, and coal have played thus far, renewables are largely taking market share away from coal. They're inhibiting the growth of natural gas that might otherwise occur in terms of carbon reduction strategies, but they're not cutting into natural gas. So then the question is, has the last 2 months affected this one way or the other? I never put it beyond governments to come up with non-market or non-economic impediments on companies and industries. But I got to think, here in the U.S., we now have over 30 million unemployed people. That's just the number that applied for unemployment insurance in the last 6 weeks. It doesn't count those who were unemployed before, and it doesn't count those who haven't yet succeeded. It puts us at a 20% unemployment rate. I just have a hard time seeing, and Europe, I think, is in a similar situation. I find it difficult to believe that governments are going to impose uneconomic solutions on people at this point in time. And many of those who are employed have had reductions in their income. So we'll see. Governments can do anything. I certainly wouldn't take either side of that bet. But I think it's less likely now than it was before the pandemic.
Yeah, I'm gonna generally agree, which is interesting. I don't know if that's good or bad because consensus is sometimes a dangerous place to be, but I generally agree, just because I think the economic hardship that is already being felt across particularly developed countries of the world, has placed significant fiscal and monetary burdens on those governments. And to imagine another wave of stimulus that is attached specifically to a particular industry or policies as economies recover that inject additional burdens on recovery, that's hard for me to imagine happening. You never say never, but I do think that because of that, you'll see the paths of least resistance often taken, which will generally mean promoting low-cost fuels in an effort to reduce carbon intensity. And I think that's where gas plays a really important role, at least over the near to medium term. So I couldn't agree more with what you both said. So we are running up against it on time, and there's been a bunch of questions that have been posed. Really appreciate those. One thing that I do want to let everybody know, even though we couldn't get to all your questions, is you can actually view these later, the webinars in particular online. We actually have them all posted and archived, going back to when we first started doing this. So I encourage you to do that. And if you have questions that you really are really burning and you want to follow up, please feel free to reach out. We're more than happy to take those up in as real time as possible. One thing that I do want to finish on, because I thought this was actually a really interesting economics question. It was really about LNG exporters, and Stephen, maybe you can chime in on this one too, definitely. LNG exporters who were targeting Permian Basin supplies as feedstock for their terminals. If Waha is strengthening, does that actually change the economic calculus for those facilities going forward? Personally, I don't think so, because I think as you start to tap into those regions through additional pipeline capacity, et cetera, there should have been a general recognition that price there would strengthen. But even though Waha is now in positive territory, it's still pricing at a discount to Henry Hub and other Gulf Coast locations. So I still think that is generally a valuable source of gas going forward. Of course, the price reality in the region will very much depend on what happens with oil prices and associated gas production, and ultimately flaring policy, which I think is something that is often underappreciated in terms of how valuable those export projects could be. To the extent they develop infrastructure to move gas, it could actually abate flaring. So Stephen, I don't know if you want to chime in on that or not.
I agree with all that. I guess I'll just add, there was a general, I think, assumption in the market that pipeline capacity was eventually going to be added to bring Permian gas east, and that would, when that occurred, that would result in flattening out of that basis differential. So I don't think there's a lot. I don't think that positive, that the difference between the negative basis and the positive basis is that influential on a 20-year set of economics for a project. But I'd be interested. There may be some people out there who feel very strong the other way. I guess I'd be interested in hearing what they think. So,
sure. Thank you, Anna. Do you have anything else you want to add to the discussion?
No, I think we've had a lot of questions, and we are running up against the time. It was great to be here. I hope everybody is, enjoyed the webinar. And please contact us also via email. All our emails are on the website, Baker Institute websites, and where you go to the events, you can find all these webinars through the event page in past events folder.
Excellent. Thank you, Anna. Stephen, thank you. It's been a pleasure, as usual, to work with both of you. Hopefully it can be face-to-face sooner rather than later. And with that, we're going to go ahead and close the webinar. Very much appreciate you all tuning in, and we'll be back again at it next Friday. There'll be a discussion on U.S.-China relationship actually next Friday, but I hope you can all tune into. So with that, we'll go ahead and close. Thank you.